Good morning and afternoon, everyone. Welcome to our Introduction to Cost Segregation webinar. Now, a little bit about our company before we begin. KBKG is headquartered in Pasadena, California, and we have additional offices in Ohio, Illinois, New York, Texas, and Georgia. Since 1999, we have successfully conducted thousands of studies nationwide. KBKG's team has performed studies on facilities ranging in size from 10,000 to over 1 million square feet, resulting in the deferral of hundreds of millions of dollars in taxes. We also have highly qualified engineering and tax professionals on staff. Our engineering department has extensive construction experience in reading plans and utilizing RS means and Marshall and Swift cost estimation techniques. Our tax department provides support for all cost segregation tax-related issues, including 1031 exchanges, AMT, passive activity, abandonment write-offs, and lease provisions. We are a preferred provider for thousands of CPAs across the country. And today we have our guest presenter, Jeff Gann, and I'm going to turn it over to him so he can tell you a little bit about himself.
Okay, thanks, Allison, and welcome everyone. Hope everyone's been having a great summer vacation, as many of us are in the tax and accounting industry, if not all of us. I hate to bring this up, but I know tax extension season is right around the corner, so let's try to get to the beaches and enjoy some sun before we don't see any of it. Okay, a little bit about myself. I'm a manager at KBKG. I'm based in our Pasadena location. I'm a certified cost segregation professional, and that's part of the American Society of Cost Segregation Professionals. I'm an alum of USC, and my industry experience is in the engineering, construction, and real estate industries. I've been working on cost segregation studies since the early 2000s. Now, some learning objectives of this course. By the time I'm through with everyone, you guys will be able to explain, hopefully, what cost segregation is, how taxpayers could benefit from it, and basically what has been updated in the industry over the past few years. You'll be able to identify tax issues that should be considered in conjunction with a cost segregation study, and you'll be able to recognize the impact of how cost segregation studies have on estate planning. And note there, it's not what typically is seen as in the step-up basis for the heirs. We'll discuss the impact of the PATH Act in late 2015 and how that impacted our industry, cost segregation. And we'll be discussing cost seg opportunities related to the tangible property regs, or the repair regs, as the term was coined. We'll be able to identify new opportunities to immediately deduct the abandonment of assets within buildings, avoiding recapture tax, and expensing demolition costs. So before we get into cost segregation, let's talk about the types of real estate transactions that this deals with specifically. So cost segregation generally falls under two umbrellas, as I like to think of it. The first is acquired property. So in our studies, we see the majority of our studies dealing with acquired property. Now these are existing buildings or existing properties that taxpayer will come along and purchase. So when they purchase that type of property, they're purchasing generally that building or multiple buildings and the land improvements that are part of that property, so the outside site area. Now the other umbrella is called new construction, and new construction could be building up a building from the ground floor up. It can also be talking about remodeled property. So if you're in an office building, then if your company is doing a remodeling of the carpeting, the walls, painting the walls, maybe redoing windows, all of that sort of action is qualified for a cost seg study. And then there's a build-outs are also under new construction, in the sense that, let's say that there's a new mall being constructed, and your client is a franchisee of McDonald's and they want to build out one of the food court spaces in there. So all of that is a great candidates for a cost seg study. Now, you can go far back as 1987 to perform a cost seg study. However, the amount of depreciation that you can take on an asset is limited to just that asset's basis, or what the remaining basis is on that asset. So cost segregation accelerates the depreciation of an asset. It doesn't increase or decrease the amount that is to be depreciated over time. So although you can go back to 1987, a good identifier of cost seg is the remaining basis that's left in a property and how many years are left to depreciate that property. So as we see here on the slide, cost segregation usually takes an asset that's 39 years, like a commercial building, or a residential rental building, like an apartment complex, which is depreciated over 27.5 years. And we reallocate those assets into shorter tax lives, thus accelerating depreciation. This next slide shows a bar chart of that accelerated depreciation. Now, without a cost segregation study, you're going to be taking the same amount of depreciation over the years. So in this case, 39 years, generally you're taking the same amount of depreciation each year. And then the purple line, you can see the cost segregation study's impact on depreciation. So you're getting a lot of depreciation up front, or you're accelerating it. And yes, that means that there will be a point in time where the deductions will be less than the straight line. And really what that is because you've been taking it, or you've been accelerating those deductions up front, so there's going to be less later. The way that I like to relate a cost segregation study is a bottle of water. If you have a bottle of water and you're taking sips of that bottle of water generally throughout the day, even sips, then by the end of the day you'll have finished that bottle of water. Now let's say it's a hot day, or if you're really thirsty and you take bigger gulps. So the amount of water that you're taking is, by the time you finish the bottle, is going to be the same. But because you've been taking bigger gulps, you're getting more depreciation if we relate that to cost seg. So the amount of water in the bottle, or the amount of depreciation that you'll take, remains the same. You're just accelerating it up into future years. So let's get into an example of how this affects our clients. So an example is an acquisition of a $5 million office building. Now, without a cost seg study, those costs are depreciated straight line over 39 years. Now, with the cost segregation study, we can see that in this example, about $750,000 has been reclassified into 5- and 7-year property. $500,000 has been reclassified as 15-year property. And then the remaining, of course, stays into the 39-year property. Now, with this example, what that means is over the first 5 years, you're looking at increased depreciation deductions, or the bigger gulps, of $930,000 in order to reduce your taxpayer's taxable income. So if we use some assumptions with our net present value calculator, that benefit to the client is about $284,000. Now, what types of properties may be eligible for a study? So it's important to understand that all types of commercial properties and residential rental properties are potential candidates. So what we have on this slide is a very general table that describes what a cost seg study can yield on average for different types of facilities. We can see here that different types of facilities obviously have different types of results, but depending on what type of facility is and what type of functions that are being performed inside that property or building, that building could be at a lower end or higher end of the spectrum. So keep in mind that we didn't break this detail out into the individual category recovery periods, meaning the 5 and 7 and 15-year properties. So instead, we just wanted to show you the average percentage allocated so that you can see how these ranges vary per industry, per type of building. So one big anomaly to note on this slide is going to be the amount of land improvements. So the amount of land improvements can tremendously affect your 15-year allocations. And so depending on whether a 15-year property exists, you could find yourself on the lower end of the spectrum or the higher end. Like let's say a building in New York, usually when those are purchased, there's not a lot of site work outside the building's footprint. If you're buying a huge mall with a parking lot that's surrounding it, then there's going to be a lot of 15-year life assets. Note, a parking structure is 39 years and is not considered a land improvement. Now, real quickly, we'll get into some personal property examples of what qualifies as short life property. That's track lighting, decorative lights, wall panels, counters, countertops, bars, and appliances. So other items that a cost segregation study usually doesn't, or that a typical taxpayer may not be able to identify, are the plumbings and special piping, electrical wiring and conduits, and then there's soft costs that need to be allocated. So at KBKG, we take on an engineering approach, and so we look at blueprints, we take measurements, and we carve out personal property out of items that would normally be classified as the building. So that's really where the benefit lies when you take an engineering approach. Some land improvement examples are, as I mentioned, everything outside the building's footprint. So we're talking about sidewalks, swimming pools, fencing, waterways, drainage facilities, landscaping, and so on. Now, some tax considerations is a cost segregation studies, the depreciation deductions can reduce your AMT. And on new construction, bonus depreciation can be applied to reclassified items that magnify the benefit. So what that means is in having a cost segregation study done, you're identifying shorter life assets. Well, when you identify any maker's property 20 years or less, you're actually making them qualified for bonus depreciation as long as that asset meets the other criteria of bonus depreciation, such as has to be original use and not an acquired type of property. So if you didn't have a cost seg study done, those assets wouldn't get bonus depreciation. Now, unused deductions carry forward as a net operating loss, or NOL. And when a building is sold, the taxpayer must recapture depreciation taken on personal property. And recapture is, in general, you'll have to take. So the rule of thumb in terms of when to have a cost segregation study is if someone is going to be selling that property generally within 3 to 4 years, typically a cost segregation study doesn't make sense because of the recapture tax rules. However, we have seen some clients still wish to have a cost seg study done even though they know they're going to be selling the property soon. They just needed those deductions right now. Okay, accounting method changes for look-back studies or retroactive studies, meaning a cost segregation study done on a real estate transaction that happened in the past and not the current year. Those are addressed in the Form 3115, and there's a calculation in there called the 481A calculation that basically trues you up to all the missed depreciation. Just know also that passive activity rules can offset the benefits of a cost segregation study. We have a couple of slides on passive activity rules. And then 1031 exchange rules also need to be considered. So typically in a cost segregation study, a look-back study, you'll only be able to do a cost seg on the excess basis and not the carryover basis. Okay, other tax considerations. When a building is sold, a taxpayer must recapture the depreciation previously taken on tangible personal property. So this section 1245 recapture tax is calculated at ordinary rates, a high of 39%, which leads us to recommend the holding period of at least 3 to 4 years or 3 to 5 years when considering having a cost seg study done. Now, when a property is sold, the fair market value of the 1245 property in a building may be uncertain. The seller can minimize recapture by allocating more of the sales price to real property instead of to personal property. So in many situations, the personal property in a building may have little to no value left. An example of this is carpeting and maybe some lighting installed a decade ago. That probably has minimal worth, especially if the new owner has plans to replace it. So in cases like that, it's appropriate to allocate only a nominal amount of the building's purchase price to carpeting. In other words, proper evaluation of personal property may yield to lower overall recapture tax. And also just know, if you were to retire, that those older assets that on sale, you're not paying the tax on those assets either. So that can be a permanent tax savings there too. Now, many taxpayers have operating business entities that obtain a property and then sell it to them, and then rent it to themselves. Now, this can be a great tax planning opportunity for us, but there's some issues with the self-rental rule. So here are the facts. A taxpayer rents to a business in which she or he materially participates in is subject to the self-rental rule. Now, rental income from this activity is considered non-passive, and any related losses from the activity are always considered passive losses. So let's say that we have an LLC that owns real property, and we're also 100% of the shareholders in an S-Corp operating entity that's leasing that real estate property. We also own some apartment buildings and have some suspended passive losses. We may want to raise our rental rate in order to generate more revenue in the LLC that rents to the operating entity. That way we could offset that income against our suspended passive losses from the apartment building. However, as many of you know, this situation can't happen because the income from our self-rental activities is always going to be non-passive, and we can't offset our passive losses with non-passive income. So if our self-rental activities have losses, those are going to be passive. So if we have passive income from other activities and we have passive losses from our self-rental activities, we can offset those. Another thing that people ask is, what happens if I have passive losses at the beginning of my self-rental activities, and in a couple of years down the line, I get to a point where I have non-passive income? So in cases like that, as long as it's related to the same property, you can actually offset that non-passive income against your prior passive losses on the same self-rental property. So again, you can offset those prior passive losses from self-rental activities against non-passive income in a subsequent year from the same self-rental property. A couple of planning reconsiderations or recommendations are, we should consider paying for any leasehold improvements from the operating entity's perspective. We should consider making a grouping election that actually allows you the activities to be grouped for tax purposes. Now, the rental activity and the operating activity can be combined by making this election to aggregate the activities. But the caveat here is that the taxpayer can only make the election to aggregate the activities in the initial year that the taxpayer reports the activities. So this election requires the attachment of a formal statement on the tax return. Okay, a common scenario here is for the cost of the tenant to be partially shared by both the lessee and the lessor. Now, sometimes this can open the door for both parties to claim deductions based on the property with the shortest recovery periods. So it's all about the perspective or point of view here. So from the lessee's perspective, the lease should state that the landlord's allowance is only for 39-year property. There's a section out there, section 110, that sort of covers that in more detail. And from the lessor's perspective, the lease should state that the allowance is for a pro rata share of all the building components. That way the landlord owns a piece of everything that was done within that space. Okay, so the next few slides, we're going to be talking about estate planning. And so I know it's a morbid topic, but as we deal with this in our industry, there is some opportunities for cost seg. So for this strategy, let's start with some basic rules related to estates that involve real estate. Now, when a building owner dies and the property is inherited that has appreciated, any gains built up during the decedent's life are forgiven. So that's a really critical bullet point. Now, the beneficiary receives a step up, meaning that the property's tax basis is reset to the fair market value on the date of death, and the depreciation starts all over. So we know that this is an opportunity to have a cost segregation study done on the stepped up basis to the fair market value, but the opportunity that's often missed is the opportunity to have a cost segregation study done on the decedent's pre-stepped up tax basis during his final tax return, creating a permanent tax deduction. So let's get into an example here. Let's look at an apartment building that was purchased in 2008, and the date of death happened in August of 2015. Now, that apartment building was purchased for $1 million. It's considered residential rental property, so it's being depreciated over 27.5 years. No cost segregation study has been performed. At the time of death, the decedent will have roughly $728,000 worth of depreciation that he never got to deduct. The decedent will still need to have a final tax return prepared for the period in 2015 when he was alive. Now, supposing that the decedent had sold the property for $2 million before he died, then he would have had a taxable gain of $1.27 million. Now, that doesn't happen in our situation, since remember that first bullet point, since the current state tax rules forgive any taxable gains built up by the decedent. So the beneficiaries or the heirs get a full step up to the $2 million fair market value of the property, and the beneficiaries record that $2 million basis on their tax return going forward. So, as I mentioned earlier, most CPAs know that step up is a good candidate for cost seg, but what we really want to talk about is the original pre-stepped up basis that has the most value. It's undepreciated because, remember, a cost segregation study hasn't been done. So this is a very time-sensitive opportunity to apply a cost seg analysis. It allows the decedent to claim even more depreciation deductions before the death, and it lowers the building's tax basis, and it creates a higher step up to the fair market value. So the idea here is to take as much depreciation before the death by having a cost segregation study done, since the heirs get the step up to fair market value regardless of the decedent's basis. So this strategy typically yields the greatest benefits for the estate because these deductions would otherwise have been lost forever if not taken on the decedent's final tax return. So you can't amend the tax return on this, but you still would have to have a 3115 performed on the final tax return. So these slides are more of how this actually works. So when we have a cost seg analysis on the building, it's as of its 2008 purchase date. It's So look-back study or retroactive study. So we identify these items in the building's purchase price that should have been depreciated with shorter tax lives. Now, in our case, a cost seg study identified $200,000 worth of things like cabinets, ceiling fans, appliance-related electrical that can be categorized as 5-year property. It also identified another $100,000 worth of things like the parking lots and landscaping, everything 15-year. And since the decedent should have written off these items much quicker than the 27.5-year depreciable life that he's using, the IRS allows him to claim any missed deductions on his final tax return, again signing the Form 3115. So in our case, when the decedent's final tax return is filed with the Form 3115, they get to claim the missed depreciation deductions of approximately $174,000 worth. So, as mentioned earlier, this also lowers the decedent's tax basis, but that's okay since the heirs get the step up to fair market value regardless of what the decedent's tax basis is. Now, because these deductions would have been lost forever, the result is a permanent tax savings of about $69,000. So I mentioned that this needs to be done on the decedent's final tax return, and that's because when a building is acquired in a tax return prior to death, in order to apply a cost seg study, a 3115 is required and generally cannot be filed on an amended return. So from the heirs' perspective, they get the step up to the fair market value and begin depreciating that $2 million all over again. But since they've already had that retroactive cost seg analysis performed, they can probably use that study or have it updated to reflect the new fair market value step up in basis. So you kind of get a 2-for-1 there. And it'll allow the heirs to maximize their deductions on the new basis. Okay, when it comes to 1031 exchanges, the first step in the tax planning process is to separate your real property under state law from personal property under federal law. So the goal here is to compare the categories of the relinquished property to the new replacement property. So as long as you're stepping up or going across in an even amount in each category, you won't have a 1031 boot issue. The first thing we want to consider in a 1031 exchange is separating the different components of the property by their state law definitions. Now, in the orange boxes, we see real property as defined under state law. Now, this category included land, 1250 property, and 1245 property that's considered real property under state law. So, building attached items. Now, when we look at 1245 personal property under state law, it would be included things attached to the building. This is applicable in most states, but you should look up what your state considers to be real property or not. Most states' personal property under state law is defined as items that are not attached to the building. So like chairs, desks, things of that nature. Now the second step here is that we need to address the recapture issues from federal laws. So what we have to do to address those federal recapture issues is to separate our 1245 non-FF&E from real property. So those two orange boxes basically became, or that big orange box in the first slide basically became these two orange boxes in this slide. So looking at the first category, we have real property under federal tax law that includes land and 1250 building and land improvements. So as long as you're going across in even amounts or stepping up into the new property that has equal or greater value than the real property, you're not going to have any recapture issues. If you're stepping down, you will have to pay recapture on the 1245 property. And again, we look at personal property under federal law that's non-FF&E, and we can compare those with each other. So right now we're going to get into the qualified real improvements. We'll talk about how that was impacted by the PATH Act. The first up is probably the most common or the most everyone is familiar with, and that's qualified leasehold improvements. We'd like to say QLI. Now, prior to the PATH Act, qualified leasehold improvements were placed in service, that had been placed in service before the end of 2014 could be treated as 15-year maker's property depreciated using a straight line method. Now, the new law made that permanent. So keep in mind that either landlords or tenants in the process of constructing the interior leasehold improvements that meet the following criteria can take advantage of the QLI treatment. It's also important to note that QLI satisfies the requirements for bonus depreciation too. QLI used to be one of the bonus criteria, not criteria, but used to be written in what is qualified for bonus, but now that got replaced by the new category, qualified improvement property, which we'll be talking about. So let's define qualified leasehold improvements. These improvements must be for Section 1245 property to an interior portion of a non-residential real property. It must be for improvements made pursuant to a lease and between unrelated parties, and we'll talk about what unrelated means. They must be for an improvement to the interior portion of the building that's occupied exclusively by a lessee. And so in other words, it can't be done for a common area that's shared among several tenants. The improvements must be completed on a building that was placed in service at least 3 years before the building's, the improvements construction date. So Congress wants us to improve older buildings, at least 3 years old. So as we get into related parties, we'll look at a cast of characters that's also based in Pasadena, the Big Bang Theory. Now, under these rules, there's an 80% common ownership that determines whether parties are related. So that 80% ownership is in both entities, the lessor and the lessee. And if there isn't an 80% common ownership, then they're considered unrelated parties and could qualify for qualified leasehold improvements. So if Penny and Leonard have 50% ownership in a retail business space, then that's one step. Now, if there is a real estate holding company that they belong to, TBBT LLC, and that breakout of the company is 35% to Penny, 35% to Leonard, 20% to Sheldon, 5% to Raj and Howard. So Penny and Leonard's ownership in TBBT is 70%, thereby making it unrelated parties. And so any improvements, interior improvements that meet the other criteria as part of QLIs, then they would get a 15-year life and be qualified for bonus depreciation. Now, with the new PATH Act rules, if they did happen to be related, they would still get bonus with the new category, qualified improvement property. However, you won't get the shortened life, and the remaining basis of those improvements would be depreciated over 39 years straight line. Note that there's exclusions to qualified leasehold improvements, expanding the building's footprint, elevators and escalators, structural components that benefit a common area, and then internal structural framework of the building can't be improved and considered qualified leasehold improvements. We get into qualified retail improvements. Retail improvements are pretty much the same as qualified leasehold improvements, except that it can be owner-occupied, and it has to be for a retail space. So retail space is basically any area that's open to the public and you're selling tangible goods. Now, as part of the PATH Act, bonus depreciation is eligible on qualified retail improvements in 2016 going forward. Second slide here is just the exclusions of QRIs. Now, restaurant property is a 15-year recovery period and that has also been permanently extended. So just note, restaurant property is can be applied to acquired buildings. So if your client purchases an existing McDonald's, you will get that 15-year recovery period. It doesn't have to be new construction like qualified retail improvements or qualified leasehold improvements. Now, the new category of property, qualified improvement property, is basically a loosened set of criteria on the qualified leasehold improvements. So qualified improvement property, the building just has to be placed in service before the improvements were placed in service. So the building could be 2 years old and then the improvements been placed in, or the building could have been placed in service in 2016 and your client is making improvements in 2017. And so those improvements would qualify as qualified improvement property. They get bonus, but again, they don't get the shortened 15-year tax period. Exclusions for qualified improvement property are generally the same as what we've seen. Now, the PATH Act here has also given us a roadmap for bonus depreciation. Since 2008, we've been enjoying pretty much a stable bonus depreciation rate of 50%, except for there was a time in late 2010 and all of 2011 where bonus jumped up to 100%. But since 2008, we've been really enjoying a 50% bonus rate. However, all of that changes as we see on this slide. Next year, bonus is going to be 40%. It's actually going to be decrementing. 2019, it goes to 30%, and then as of this time right now, bonus sunsets in 2020. So a lot of these qualified real improvements are seen on the handout. They can also be found on our website. It's basically a chart that goes over the different types of property. It shows the different types of criteria, whether or not it's bonus eligible, if the 3-year rule has to happen, unrelated parties rule, all of the things that we talked about. Also talks about 179 expense eligibility. And then for those technically oriented on the right column, it shows the code section in which these rules are found. Now, just know that this slide is a snippet of the larger handout, and so I advise you to print out that handout. And if things change in the law, as what may very well happen with this administration, check back to our website. We keep up to date on these things, and we update this chart specifically. Okay, so there's a general a GAA election for demolished buildings. Basically what this is saying is that if you put a building in a general asset account, you can still depreciate that building even if it's been demolished. Now there's special rules for this on the following slide. Just know that it's a gray area. If you know that there's intent that gets looked at, so if you know that a building is going to be demolished after you purchase that property, you generally will not be able to take advantage of this. So just know that demolished buildings in general will usually be attributed, the basis will be attributed to land, and you can't be depreciating it. But this election allows you to still depreciate that still over 39 years. So these next two slides talk about the specifics of that. You can read more about that on our website as well. As we get to a Pico Food slide, basically what this is saying is a purchase and sales agreement is very important. In this case, the taxpayer had writing in there that gave a value to personal property, and when they had a cost segregation study done, the IRS threw it out because it basically stipulated in their purchase and sales agreement that a value was placed on personal property. So you can't use terms like that for your property. The other case that's important to know in the cost seg industry happened in 2012 also, and that's the AmeriSouth case. Basically, this was an apartment complex where they had a cost segregation study done, but everything was overturned in favor of the IRS. And the IRS rejected everything in there. And when looking at this case, the cost segregation study wasn't that aggressive to begin with, but there were some things in there that shouldn't have been classified, but not everything should have been overturned. To make a long story short, the reason why everything was overturned in this case was because when the tax court was inquiring to the taxpayer, AmeriSouth, about this, about their cost segregation study, AmeriSouth had actually sold the property, and so they didn't want to return any calls from the tax court. And so the tax court had no other option but to side in favor of the IRS. So when someone throws out this case to you, just know that there's certain circumstances or context surrounding behind the positions that were made as a result of this case, and that's what it was. The building was sold, or the property was sold. Some other recent guidance before we get to the polling question number 3. HVAC rooftop units don't qualify as qualified leasehold improvements. Bonus depreciation rules they specifically look for place and service dates. So as we move forward, place and service dates are going to be more important. As I mentioned earlier, bonus depreciation, the rate is actually going to be changing. So we're going to see a lot more issues with when a building is placed in service because the rates are actually going to go lower. Everyone's going to want to be placing their properties in service earlier. Then there's tangible property regs, which we have a couple of slides on. And then the PATH Act, which we've talked about, that was signed in late 2015, but a large part of those provisions take place for property in 2016 moving forward. So on this slide here, it pretty much talks about the retail and restaurant industry safe harbor. Basically, if you have a larger taxpayer or a taxpayer that has an applicable financial statement or a financial statement that's going to be audited, there's a safe harbor out there that allows your client to to deduct 75% of the refresh or remodel costs for the restaurant or retail space. So oftentimes a restaurant like McDonald's, they'll have to change their logos or update the look of the restaurant, maybe 5 to 7 years. So now you can write off 75% of those costs. They have to be qualified costs, of course, and in knowing what qualified costs are, they're basically non-1245 property, so all the real property. So a cost seg study helps you determine what those qualified costs are. There are some industries out there that are excluded from this: automotive dealerships, gas dealerships or gas stations, manufactured homes, hotels, amusement parks, theaters. So there's a lot of industries that are excluded from this safe harbor benefit, but again, your client has to have an applicable financial statement, so it's usually a larger client. Now, with retirements and dispositions, this goes into our tangible property regs. So the current regs allow you to take a loss deduction when you remove components from your building. So the example shown here is if you paid $50,000 for new HVAC units, those old HVAC units that you retired, once you have a value for those, whether through a cost segregation study or not, you can write those off as a loss. And so we have a partial disposition calculator on our website. You can do this on a go-forward basis. Just note you can't do late partial dispositions. There was a time, like in 2014, for 1 year only that you could do that, but now you can't. You can do full dispositions in the past, so late full dispositions, and you could also do current partial dispositions, but you can't combine the two and have late partial dispositions. That makes sense. Okay, so this is an example that I'm going to skip over due to some time. Just know that retirements create permanent tax savings. They're a really big boon for taxpayers. These next few slides will jump all the way to the cost of demolition. So what this slide is saying here is that removal costs can be deducted for if a taxpayer retires an old component for tax. So this was kind of in our way of talking about the abandonment and retired components. So this is an example of that. The next slide says the plan of rehabilitation expenses. So what used to happen was if you had a repair and maintenance expense that wasn't dealing with a bigger improvement, let's say that you replaced the roof of a building, but you were also redoing the entire insides for a new tenant space. In the past, you would have had to capitalize that repair and maintenance expense, but now with the tangible property regs, you're basically saying if you have a repair and maintenance expense that's not related to the scope of the work of an improvement that's happening, you can now expense that properly as a repair and maintenance expense. So the next slide is an example of that. And then the next couple of slides, we talk about the bar test. So the bar test is a determination of whether or not to capitalize an improvement or to file it as a repair and maintenance expense. So in your handout, there's a flow chart that goes over what is a betterment, adaptation, and restoration. These slides also go over them, but again, due to time, sorry, we pack in a lot of our slides just for reference, as I mentioned earlier in the webinar. So I'm going to go over this really quickly. So a betterment is basically updating that unit of property to have more efficiency or more productivity or size. So if you're replacing halogen lights with LED lights, you're bettering that asset or that unit of property. So generally, improvements of that sort have to be capitalized. Adaptation is if you're adapting that unit of property to a new use. So if you had a auto dealership and you had a sales floor, if your client was going to redo that sales floor and make it that part like the new back office area with computers and things like that, then that's an adaptation. Restoration is if you're restoring an asset to its intended use. So if you're replacing, let's say, the heat pump in an HVAC unit, so the heat pump, it provides a critical and discrete function to that unit of property, and so replacing that has to be capitalized. So these next few slides talk about that, betterment, adaptation, and restoration. Then here's an example of our HVAC example. So just kind of wrapping up historically, cost segregation studies have been focusing on 5, 7, and 15-year property. But now, as we've discussed, the cost seg studies do a lot more. They identify repair expenses, demolition expenses. They can be used for future retirement of property. You can even have studies done on just retirement of property. Section 48 properties, tangible personal property. The bonus rate, once you categorize a property from 39 years to 5, 7, and 15 years, you're generally making it bonus eligible. And then even in the 39-year components that you identify in the cost seg study, those can be used for future repair and maintenance expenses or even retirement opportunities. So when considering a cost segregation provider, you generally want to make sure that you're going with someone that's up to date with all the latest changes and rules. A certified cost segregation professional is usually a good start. You want to be evaluating the bios and resumes of who's signing your report, if anyone is even signing it. Consider how long the firm has been doing cost segregation studies. and consider also experience with the TPRs, the Tangible Property Regulations. And if the study goes under audit, consider who do you want to be defending you, or even if audit support is included in a cost segregation study, you and your client don't want to be left holding the bag. And just know, I guess the last bullet point is fairly obvious, but low cost or smaller boutique firms may not have all the resources to stay on top of all the regs. So you definitely want your clients to be represented with the best resources available. So thanks everyone for listening. Contact us if you have any questions.